There we go. Okay, that's my mic? Yeah, it is the mic. Okay, sorry guys, I am back. Thank you. Okay, I was just saying I'm running on fumes, so we'll see how we go, and we're going to go until about 10, hey? Okay, okay, where was I hadn't started anything, hey? Dividend policy, mergers, and we're going to do, I'm going to take you through those mergers questions in detail. Okay, load shedding at 6, so if we do disappear, we shouldn't disappear off the stream. We should just kind of disappear off the screen for a second as there's no light. But sure, is it just when I'm here that nothing works? Gary, you should switch it on, and then it tends to work. Okay, I think the battery's flat. There we go. Okay, I think it's actually a delay on the computer. Okay, so we're going to do dividend policy first. Okay, I'm going to talk about a couple of things. I'm going to talk about, firstly, do you remember that if you look at any of the textbooks, they talk about there being 3 finance decisions. Okay, we did investment, capital budgeting, all of that kind of stuff. We did financing, structure and WACC and all of that kind of stuff. And now we're going to move on to the dividend decision, a third decision. Part of what it is it actually a thing? Is it something we have to manage, okay? Or is it actually just, if there's money left over and there's money in your bank account and you want to give some to the shareholders, do we just give it to them? Okay, which one is it? Okay, it's very much like a strategy question, so you're going to see I'm going to talk, especially later on, I'm going to talk a lot about, like we did in strategy. Make sure that you do the identify, we'll talk about it just now, identify, explain, apply, and then link. That whole thing, you need to say, okay, cool, yes, they don't want to pay a dividend, they've got huge debt, they should rather pay off their debt. Okay, I linked it to the scenario, saying, yes, for this company, they've got too much debt, don't pay a dividend. Okay, you can't just say, oh, they've got too much debt. Okay, you need to just do it a little bit more than that. Okay, so that's that part over there. We're going to go through all the different theories that there are. Okay, and again, it's not going to be dumping theories. It's going to be taking a company saying, what do they look like? Okay, is a dividend appropriate for them? Okay, so we'll go through a brand new company that's expanding, that's got a brand new product. Should they pay a dividend? No, they need the money to expand and to grow and to get into the market. Okay, company like Pick and Pay that's been there forever, very stable. They want to pay a dividend because they literally are just producing cash, very stable. They will pay a huge dividend. So we'll look at the context of each company and then decide, do we want to pay a dividend? Okay, we'll look at, we've done the dividend growth model, D1 over K minus G, so we'll talk a little bit about that. Okay, and then that brings in the valuation part of dividends. Okay, so the first part is going to be strategy. Okay, the second part is going to be, can you actually affect the value of your company by changing your dividend? And we're going to see that you kind of can. Okay, so we'll have a look at that. Okay, then we'll talk about some of the theories, residual approach. We'll talk about the different policies we can have. We'll go into the dates. Yeah, that was more important in undergrad, less important now. Those last day to register and all of that kind of stuff. Alternative ways of making distributions. So I want to get rid of some money out of my company. Okay, is there anything else I can do? What about share buybacks? Okay, so we'll talk about share buybacks specifically there, share buybacks, and we'll talk about dividend reinvestment plans. Okay, where you actually say, hey, do you want a dividend or do you want to leave it in the company? You guys choose. Some of you say, no, we'll take the dividend. The rest say, no, keep our money and make us more. Okay, you can decide which one you want. That'll be the last one. Okay, cool. Remember that the big thing with a dividend, okay, is that if I said to you now, we've got a company, we've been running for 5 years, and I say to you, hey guys, I'm going to pay a dividend of, I don't know, 5 Rand per share. Can I do that? Just come up with a number. Oh, wait, let's make it 10. Hey, 15 sounds good. I can do that. Dividend is determined by management. You decide. It's not like profit that's earned, that I have to kind of show you that I've earned the profit, or like an asset value. It is literally somebody decides. Okay, so for that reason, if I can just decide how valuable is it to determine, say, the value of a company, where Gary can just say, oh, no, let's make it 6. Okay, so that is one of the things that we're gonna take a look at. Okay, as I said, identify, explain, apply, and link. That is just saying when you get a point, make sure you treat it like a strategy point. Okay, then I threw in a whole lot of things just to say, let's look at the market. Let's have a look at some stuff on the market, and let's see if are dividends being paid, and how important are they? Is it just, hey, if we've got money left over, let's pay it? Okay, this over here is First Rand, okay? And there's a couple of things over here. There's dividend yield. That's their dividend yield, the dark blue line. Okay, their dividend per share, how many dividends are they paying per share, is the lighter blue line, and their earnings is the pink line. Okay, so this one is that bad, but can you see that the pink line is quite volatile? It's not a nice straight, okay? The blue line is much straighter. Okay, you can see a trend. It's going up nicely. Okay, the dark blue line is kind of all over the place again. Okay, but they're all kind of going in the same direction. Okay, pink, you can't have a dividend without earnings. In certain circumstances, we'll talk about the companies, that stuff later, sometimes you can, okay, but your earnings tend to be volatile. Okay, so if I said, hey, dividends are all over the place, earnings are all over the place, so let me draw you a picture. That's what my earnings are like. Okay, so it's kind of okay, but you guys are saying, Gary, we never know where we are. Are we on the down? Are we at the up? So I say, you know what I'm going to do? I'm going to make sure that your dividend is nice and constant. Okay, doesn't that blue line there make you much more confident in Gary's abilities as a shareholder? You know, I'm guaranteed a dividend. Gary always pays a dividend. Yeah, the earnings go up and down, but he's telling us when it goes down, yeah, that's temporary. I'm still going to pay you your full dividend, even though we didn't do well here. Pay you a huge dividend because I know next year we'll do better, and there we go, next year we did do better. Okay, so dividend, you're trying to say, no, everything is okay. Okay, that's one of the things we're going to do. Okay, there is a big anomaly here, and I specifically chose this because we've been through it, and we kind of, depending on how you look at it, apparently there's bird flu coming now. Anyone see? There's a person in China with bird flu. I thought, oh, please don't do this again. Okay, 2023, so it's 10 years. That is the only time in 10 years we're not. If you had to extrapolate this back 50 years, you won't see this ever. So this was the one time in history when companies just said, hey, we need to survive, no dividends. That's how bad COVID was. It literally is evident in companies' dividends. First Rand shows it over there. Okay, so in the middle of COVID, Gary was setting a million questions saying, hey, dividend policy, we're in the middle of a mess, should I pay a dividend? And you guys should have been saying to me, hey, no, look at the mess we're in. This is an excuse not to pay a dividend. Okay, but you'll see them. There's past papers to look at. Okay, what else do I have? Dividend policy changes in global markets. Okay, you can see it going up and down over there. Okay, this again was in COVID. Okay, and what I wanted to show was we can see you growing. Oopsie. In always growth. And depending on how the economy is, the growth might have slowed a little bit on average, but it would always be there, except in COVID. COVID, it came down significantly. Okay, you can see there as well, again, just on COVID, the big drops in the dividends, the impact on dividends. So COVID had a huge impact. Okay, I know we're not dealing with that now. I just want to show you where we've come from so that you know what the influences are. And if you see it in a history, you know that you need to take it into account. So if I said to you in a question now, obviously you're not in the middle of COVID, the worst of COVID, okay? So I show you and I say, our dividends are, in 2020 were like that, and then I'm coming back slowly, okay? And I say to you, help me to determine what my dividend should be. And that over there was like that for a long time. Okay, cool, I'll change over. Okay. So So they should actually buffer and still get what I'm saying, but they can't see the screen. Okay, so Apple declared a dividend for the first time in 2012, and lo and behold, that was just after Steve Jobs left. So Steve Jobs walked in, they were paying dividends, okay, before 1996, and he walked in and he said, everybody knows who Steve Jobs is. Everybody said, he walked in and he said, no more dividends. I need the money. I'm going to make cool phones. I'm going to make MacBooks, all that kind of stuff. And he stopped all dividends in 1996 when he got there. How did you guys feel as shareholders of Apple? What the hell? This is not cool. Okay, so, and during that whole period, the first time they paid dividends again was in 2012. So his entire time at Apple, there were no dividends. Okay, so think about that as a shareholder. Normally, as a shareholder, you buy shares, you take your hard-earned money that you made in your salary, you put it into Apple shares, you get no return, no dividend return. Yes, you get capital growth, okay, but you're getting no dividend return. So you kind of start thinking, yo, that's not so cool, okay? People like Gary, who said, hey, there's value in dividends, we can show them how stable the company is. He refused to even talk to them. He said, I'm not interested in dividends. Dividends is not a thing. Okay? In 2012, when they did start, they had a cash balance of $100 billion. They had huge cash. Okay? They declared a dividend of $2.65. Okay? And then they also said, remember I said to you that if not a dividend, then what? Share buyback. So either you can say, hey, all my shareholders, here's money. It's called a dividend. And you all get your R5. Or I can say, I'm not paying you guys a dividend. I tell you what, who wants to sell their shares back to me? And I'll do a share buyback, and the company will buy the shares back. So if we had 100 shares, I will say, who wants to sell, you, and you, give me the shares back, now there's 90 shares. So each one of you that stayed has got more of the company. But we paid out cash to get to those people who wanted their money. Okay, so that would be your share buyback. Okay, so they not only, when he left, not only did they start paying a dividend, they'd spent $10 billion, okay, on share buybacks. Okay, and then I'll talk about Microsoft just now. Well, let me talk about it now. Google has a dividend payout ratio of 38% of profit. In other words, whatever their profit line is over here, that black line that they had, 38% of that they pay out as a dividend. Okay, so yes, Microsoft is paying a dividend. Google declared a stock split of 2-to-1. Okay, in fact, I'm going to come back to that. When we do the capitalization issues, I'll come back to that there. I'm not going to talk about it now. I want to stay on Apple. So here we go, okay? This is very, very familiar free cash flow and dividends. Okay, not profit, not revenue, free cash flow. How much money does Apple have? And you can see 2007, 8, 9, 10, 11, or up until 2010, not that much cash. They've got cash, but, and then as soon as Steve is gone, look at how the cash went up. Okay, cash went through the roof. Okay, and the dividends started increasing, and you can see there again, low dividend at first, and then you can see there's a trend going up. So when Tim Cook came in, it looks like he was doing better, right? Because when Steve Jobs was there, they don't have that much cash. Okay, when Tim Cook came in, huge amounts of cash, and then he started paying it out as a dividend. Okay. Okay, I've lost my clickability again. I think this computer is also having a slow day, because just now it's going to click a million times because it won't do anything now, and just now it caught up. Okay, it eventually woke up. Okay. This is also cash, okay, so a different picture. So you can see there's Steve, okay. Wow, look at Tim go. Okay, so he made, again, huge amounts of cash, okay, and paid quite a big dividend. Okay. The problem is a lot of that money was held in foreign subsidiaries. What's the problem with foreign subsidiaries? It's difficult to get your money out of some countries. They have these rules that say you can't repatriate the cash. Okay, so it's very difficult to get that money out. So in those circumstances, it's almost tainted cash. You can't just get it. Okay. But anyway, lots of dividends, lots of cash. Okay, just to give you an idea of how much cash they had. Okay, here is Apple. Okay, the blue is their revenue. How many companies have that much cash and they have, what's that ratio? 250 to about 50, about 5 times the cash in their bank account, cash and equivalents, 5 times your entire revenue for the year. Not many. Okay, that is huge amounts of cash. Okay, so that huge amounts of cash. Look at their profit. Their profit versus their cash. They just had tons and tons of cash. Microsoft, similar, but not as good. Google or Alphabet, also similar, sitting on tons of cash. Okay, Amazon a little bit better. They had less cash. Okay, why is Gary saying it is a bad thing? Did you hear how I was kind of saying? I was saying Microsoft is a little bit better. Google is a little bit better. Amazon is probably the best. Okay, when your shareholders are sitting and asking for a return, and this thing over here is on your balance sheet, how much do you earn on it? Your biggest asset on your balance sheet, by a huge margin, is cash. It's earning interest. Do you think the Apple shareholders are happy with whatever, interest earnings? No, they want you to shoot the lights out. So it's called lazy cash. Okay, it's not earning enough return. So a huge cash balance is actually not necessarily a big thing. It's fantastic that they've done well, but it's not so great. Okay, and that's why, hey, let's pay a dividend, Tim Cook, let's do share buybacks. Okay, then this is very, very interesting. Okay, and again, it's coming back to the strategic aspect. Okay, so you can see there a whole lot of lines. Okay, you can't see half of them. I'll explain to you what it is. The blue line there is Apple. Okay, so you can see over that period, 2006 to 2012, okay, that's where Steve Jobs started leaving or was leaving and leaving the company. You can see there, that is their share price performance. Okay, so massive, massive share price performance, over 1,200% return during that period. Okay, what are the other ones? The yellow, you can see there's a yellow, there's a red. Okay, that is Microsoft and Google. Microsoft and Google, their performance, they're good companies. They were doing really, really well, is dwarfed by Apple. Okay, so even though Tim was doing really, really well, Steve looked like he wasn't doing so well. Apparently, Steve was. He generated that value, which was absolutely huge. He just kept making the company bigger and bigger. Why do we not see it here? I said lazy cash. He used the cash. He went and he made new products. He spent big on research and development, and that turned into cool products and lots of value. When Tim Cook came in, he didn't have the same kind of, well, there's lots of ways, lots of people argue different ways, but he didn't, how quickly did he innovate compared to Steve Jobs? Nowhere near as fast. So he ended up with the problem of cash. Okay, let's go to the next slide. So there you can see Apple, 1,222% return. Google was fantastic at 62, but almost a non-starter compared to Apple. Microsoft, 30% return, fantastic, but nowhere compared to Apple. Okay, and I'm just reminding you, Steve Jobs said no dividends. I don't want dividends because that's what he wants to do. So when you don't pay dividends, you can grow. Okay, and that's what he said. Okay, here is after. Okay, so this is from 2011 onwards. So this is where Tim Cook took over. Let's see how he did. Just a reminder, Steve outperformed hugely. Okay, Tim Cook, Apple is the black line. Okay, Apple made still a very good performance, 203% during that period. But all of a sudden, Microsoft is right with them. Amazon is outperforming them. Okay, Google is just behind. Okay, so it's nowhere near. Apple made, or Steve Jobs made these lines flat, and he was up there somewhere. Okay, however, we know that Apple has huge cash during that period, but again, it's that lazy cash problem. So that's why one of the reasons you want to pay a dividend is if you've got too much, unless you can spend it and create new stuff. Okay, you need to keep innovating. Okay, let me just draw another picture for you quickly while we're here. Okay, do you remember we said I think there's a picture later of the life cycle of a business. A business starts off and it starts with a brand new product. They grow very, very quickly. Then they become more mature and it's harder to grow. Then they become very mature like Pick and Pay. And then all of a sudden they start declining. Okay, what Steve Jobs did is he knew this and he could see it. Apple was getting huge. He knew this was happening. So he said, no, I'm going to innovate. And I'm going to put us back into that cycle with my new product. And then when they started going there again, he said, no, let's innovate again. So he kept pushing them into that thing there. And that was his skill, was to be able to continue innovating. Okay, so we've done all of those. Okay, there you can see again the cash. Okay, the huge amounts of cash that all of a sudden appeared when he wasn't there anymore because they didn't know what to do with the money. They couldn't innovate as much. Okay, and that's why they started doing dividends and share buybacks. So you can see how quickly they grew their dividends. It was literally going up. Year by year, they increased their dividends significantly. We don't know what to do with the money. Look at that big red blob there that's it's lazy cash that's earning like 2%, and my shareholders are saying we want 17. I'm on the back foot before I even start. Okay, and then you can see what they did is the gray is the dividends, okay, that they were basically paying, and then the blue is the share buybacks. Okay, so they did huge amounts of share buybacks, basically buying their shares back. Okay, so that's just kind of an example of a company with their dividends. It's the opposite of what you will normally see. Normally a company says, hey, I want to show the nice flat line, and let me show you my dividends. Pick and Pay will have a nice flat line. Whereas Apple was the absolute opposite. They were saying, no, we want the growth, we're not going to pay a dividend, until it got to Tim, and then all of a sudden he wanted to pay dividends. Okay, this over here I'm going to go through at the end of the lecture. Okay, this is basically a summary. If you get a strategy question on dividends, this is a summary of all aspects of the dividend. Okay, the different things we're going to go through now. Okay, so I'm not going to go through them all now, but that's all the different theories. Okay, these are the alternatives. What can you do if you don't want to pay a dividend, but you still want to pay out money? Okay, you're sitting with too much cash on your balance sheet, pay a bonus dividend, or go and buy back some shares, for instance. So that's the alternatives, and these are all the non-financial considerations. So these are financial from a purely analytical perspective. Let's have a look at it and see if it makes sense. And this is all what is the little old lady that wants to go to Checkers and can't because you didn't pay her a dividend, how does that affect you? So all the non-financial aspects, we'll talk about those separately. Okay. When we get to the end of dividends, we're probably going to find out that, but this is far more important. The non-financial considerations are going to be far more important. Okay, I said to you I'm not going to spend a lot of time on the dates. You would have done this somewhere in undergrad. Gary decides, hey, I'm going to pay you all a dividend of R5. I declare the dividend on that date. Okay. We've done CumDiv and we did it in WAC. Okay, from that date, okay, if you own the share, you get the dividend. You guys still get it. You still get the R5. We get to a point where we get to the ex-dividend date. That's where all of a sudden we say, okay, cool. Everyone who has the share, okay, at this point in time, the 2nd of November, everyone who has the share, we write your name down on a register saying you're going to get the dividend. Okay. And then from there, the share trades ex-dividend. Because no matter whether you guys sell your share to somebody else, you keep the dividend. Your name's on that register. Okay, so the dividend and the share split. Okay, the share price and the dividend split, that's on the ex-dividend date. The record date is just where is it? the corporation prepares for all the individuals, okay, so it's just an admin part, and then eventually we pay the dividend later to everyone who's on that list. Okay, price behavior. If I ever give you a question and say, hey, we decided to actually pay a dividend, and on the day we pay the dividend, I literally pay out the cash, the valuation, the value of my company has to drop by that value of cash. If I take 10 million out of my cash and I give it to my shareholders, my company value has to drop by 10 million, right? Okay, so you normally see on that day you pay the dividend, you see an immediate drop in the share price. So if you invest in a share and all of a sudden on one day the share drops materially, could be that they did something wrong. It could just be that they paid a dividend. Go and just check that they didn't pay a dividend and that's why the share dropped. Okay, taxes and information content sometimes do make it that it doesn't drop by the same amount as the dividend, but we'll talk about that a bit later. Okay, I've spoken about this already, so now we're going into some of the notes parts of it, which I've already covered. Dividend decision, investment decision, financing decision. Do I decide which projects I'm going to invest in? Then go find the money, make some profits, and if I've got money left, then I pay a dividend. Or is this a conscious decision that can change the value of my company? Is it a conscious decision that I have to manage? That's what we're trying to determine today. Okay, so can it affect the value, or is it merely a consequence? Okay, I pulled out a couple of quotes from financial analysts. Okay, so if we have a look, analysts are increasingly upbeat about Old Mutual and its ability to resume paying dividends. So you are a Fin24, you Mark Ashton, you are a Fin24 reporter, and you can say something about Old Mutual, and you decide to report on their dividends, and you say, hey, my shareholders are really happy, my analysts, because we think we're going to start paying dividends. Okay, what had happened before that is they'd cut their dividend. Now the analysts are all excited that they're going to start paying it again. Surely that means it's very relevant. Okay, so Mark Ashton definitely thinks it is relevant. Okay, they had changed from to a buy from a hold. Okay, so analysts normally say they rate shares and they say, okay, cool, for Old Mutual, is it a sell? I don't like the share. Okay, I'll publish it. Hey, I am Mark Ashton. For Old Mutual, I'm going to label Old Mutual as a sell. So in other words, my view is I don't like the share. Or is it a hold? If you've got it, it's okay. I wouldn't go buy it. But if you've got it in your portfolio, keep it. Okay, that's a hold, okay, versus a buy. A buy is, hey, go get them. Fantastic. Okay, he changed UBS Securities upgraded them to a buy from a hold on the basis that they would start paying dividends. So they said, yo, hold on until, you don't sell it, but don't go buy more, go buy. Just because they paid a dividend. Doesn't Gary get to decide if it's 5 or 10 rand? So even though I can make up the information, it's powerful information that will change an investment decision. Okay, so it is huge information. Okay, they'd elected not to pay a final dividend because they had significant pressure. So they had come from we're not going to pay a dividend to, hey, we think we're going to start paying dividends again. Everyone wants their share again. Before, nobody wanted it. So it's a significant thing. Okay. The market has responded particularly negative to companies which have not paid dividends. Okay, so Apple and Steve, okay. Okay, here's a different one. Okay, Sam Hooley, Investec. He identified 2 stocks whose management elected to cut dividends this year. Okay, Sun International and Old Mutual. Okay. He, however, says both of them made the right decision to cut dividends. Okay. Okay, so what happens when you cut your dividend? This over here is Old Mutual, okay? This is when they cut their dividend. Okay, over there on that spike going up, and they came all the way down when they cut their dividend. This is a long price history. If you look very, very carefully, okay, that there is about 900, okay, 900, their share price is 900. In a very short period, they cut their dividend. They are now at 450. Everyone know who Old Mutual is? It's huge. It's a huge financial services company. Just because they cut their dividend, the market halved their price. 50% decrease in their price. In fact, yeah, from 900 down to 450. So is it bad news to cut your dividend? Okay, and then once they got to the point where they probably around here said, oh, we're going to pay our dividend again, all of a sudden everyone wants a share again. So dividends, a cut in dividend is going to wipe you out. Okay, this is Anglo-American. Okay, Anglo-American at that point over there, okay, this spike over here, at that point in there, over there also said, hey, we are going to cut our dividend. This is historic. This was in the middle of the credit crisis. Remember with the housing bubble and states, everyone was dumping their houses and the house prices fell and that whole contagion effect. During that period, the entire world economy started doing badly, okay? Anglo-American said, hey, at this point in time, they said, hey, we are surviving this thing quite nicely. You know, you can see we're doing okay, it's a bit volatile, but we're doing okay. But you know what? If we don't pay a dividend, okay, all of the smaller mining companies, all the junior miners, they are really suffering. They are going to liquidate. I want to go and I want to buy up all of those little companies while they are in distress. I can get all of their assets at a bargain. Doesn't that sound good? As a shareholder, who wants that? I would put my money in it. I'd say, yeah, no, go shopping while it's cheap. We're buying stuff on sale. Okay, so they said, hey, we're going to go buy stuff on sale in the middle of a credit crisis. But to do that, we're not going to be able to pay you guys your dividend. Sorry, it's not because we've done badly. Our profits are fine. Our profitability is fine. We're weathering the storm. Okay, but I need the money. Okay. Nearly 220 Rand down to, about 14 Rand. Again, nearly a 50% drop. In spite of the good intention with the money, 50% drop in the share price of Anglo-American. It was diabolical. Yeah, but it all makes sense. No, you cut your dividend, your share price is halving. Anglo-American, a big global mining company, and they sliced their value in half. So can dividends affect value? Most certainly. Yes.
I'm a bit confused because you said it's stating that the value of the share might drop, and the same also if the other things have the same.
Okay, so it's two different things, okay? If I'm trading along, okay, if my share price is trading along nicely, and I pay a dividend over there, I declare a dividend, but I am paying a dividend, okay? And as I pay that dividend and the cash goes out of the share value has to drop. Think about it. If I have a share at that point in time that is worth 100 Rand, and I pay out 10 Rand per share in a dividend, that means that the asset, take the balance sheet, the asset value went down by 10 Rand per share. Surely that value there has to go down to 90 because I paid 10 Rand out. You happy with that? Okay. The other one is slightly different. I trade on a little bit. Okay, so that, sorry, not there. Okay, so I pay the dividend and I drop by the value of the cash. Okay, but I still pay the dividend and I still carry on trading. Okay, then I say, ooh, there we paid a dividend. We pay 10 Rand. And I say, oh, guys, sorry, no dividend for you. I'm not going to pay a dividend at all. I'm not paying a 10 Rand dividend with my value. 50% decline. Based on the information. Okay, and we'll talk about what that information is now. Okay. Okay, so Anglo and Old Mutual, they're not little companies. They're not unstable companies. Okay, dividends and capital structure. When you pay out a dividend, it does affect your capital structure. So do you remember that dividend, the capital structure thing that said, hey, we need to get to our optimal capital structure, and that's the value of my company. This is the amount of debt I've got in my company. So I need to make sure that I've got a debt equity that maximizes value. As I take more debt, I get cheaper interest and I get a tax benefit, okay? But after a point, I start running into problems. and I start having bankruptcy costs, and then I start coming down because debt starts becoming too expensive and too risky. That's the bad side of debt, the good side of debt. I want to get over here. When I pay out a dividend, I move up and down. Because remember, I'm messing with my equity. When I pay out a dividend, my equity goes down immediately. When I paid out that 10 Rand, my equity went down. So I will immediately say, oops, now I'm over there. I'm not at the optimal capital structure anymore, so I'm going to have to try and get back there. I need to try and get back there by, I don't know, either taking out more debt or I need to adjust. So just remember, if I do pay it, I need to. Dividend is going to reduce my retained earnings, and therefore I'm going to have a change. Okay, it may also reduce my borrowing capacity. Okay, sorry, I actually went the wrong way. Did anyone notice? Okay. I've got debt equity. Let's say it's 50-50. Debt equity. Okay, and I pay out a dividend of 10. That goes down to 40. That stays at 50. So when I pay out a dividend, I actually go that way. Okay, I go onto the bad side of debt because I've got too much debt and not enough equity. And then I have to get back that way. So sorry, not the other way. It reduces my equity, which messes up my debt equity. Okay, and it says there at the bottom, that might reduce my borrowing capacity. There the bank says, yeah, no, you've got lots of equity, we'll give you some more debt. Here the bank is saying, oh, you've got more debt than equity. No, sorry, that loan, we're not going to approve it. So all of a sudden, I can't go borrow from the bank. So paying a dividend can have a bigger impact. Not only do I lose the cash that I pay out, I also lose debt capacity. Okay, because debt equity needs to balance out. Okay. And of course, it deprives me of profitable investments. If I pay that 10 Rand out to you guys, I can't go do cool stuff with it. So therefore, we're going to lose profits. Therefore, growth is going to go down. As soon as you pay out a dividend, growth has to go with it because I don't have the money to grow with. Okay. Okay, so the residual policy, okay, the residual policy, I don't need you guys to regurgitate this stuff to me. So I don't want you to go learn, I want you to know what residual policy is from a principle perspective, but I'm never going to ask you, hey, tell me what the residual policy is. Okay, residual is saying, hey, you know what, only if there's money left over. If there's money left over, okay, I will pay you dividends. In other words, I'm going to do something like this. Okay, I'm going to set up, hey, I've got project A, project B, new iPhone, new tablet, iPad, there's my iWatch, blah, 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 down to new MacBook. Okay, so I'm going to do all of those projects because they all got positive returns. Remember, this over here, this over here is my WACC. So weighted average cost of capital going up the side. There's my weighted average cost of capital. That is the IRR each one of these investments is making. If it's making above the WACC, invest. Okay, these are all little NPVs that I did. Okay, as soon as I go below WACC, the power switches off. Okay, let's just wait a second for the generator. We should still be online. In fact, I can carry on actually, because we should still be online because we're on this thing over here and it's on the inverter. Are we still connected? Okay, must look freaky. Okay, so what was I talking about? The project schedule. I take all of those projects. If I get to a point where I've taken all the projects I want, okay, and I still have money left over, I've done the MacBook, I've done all the rest of the things that I watch, and I've still got money left over, that's when I say, hey, you know what? Let me pay out the remainder as a dividend, because I can't do anything with it. So if I can't do anything with it, hey, let me give it back to you guys. So that residual approach says, if I get to that point, there's money in the bank, by all means pay it out. Okay, but if there's projects, don't. So residual says it's very simple. If you don't have projects, you pay a dividend. If you do have projects, then don't. Okay. 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 I was hoping it would come back. Oh, there we go. Okay. So I just did a quick little example. Okay. So I've got my project schedule. Okay. Okay, so if you have a look at that over there, if I had profit of 1,000, okay, and I need 800. I need 800 for my projects, all of the viable projects. I'll pay out the remainder as a dividend. Okay, so that's basically what I'm saying. 1,800, pay out the 200 as a dividend. Okay. If my profit was, however, 700, remember the impact of debt and equity. Okay. Okay. If I have a profit of 700 and I have a debt equity of 1:1, 700 is equity. Okay, but that also means I can go and raise another 700 as debt. So I can raise a full 1,400, correct? Okay, so what I'll do is I say I need 800, okay, but half is going to come from debt, half is going to come from equity. So 800 divided by 2, I need 400. I've got profit of 700, pay out the remainder 300 as a dividend. Okay, everyone with me? Okay. So again, this is residual policy. This is a residual approach where I just say if there's excess, I pay it out. That's how I calculate it if I've got a debt to equity. Okay, if I've got profit of 350, okay, I need 800. Okay, 800 divided by 2, I need 400. Okay, I've only got 350, 700. No, did that not update? Yeah. I've got 400. I've only got 350, okay, which means I've got a negative 50. In other words, I'm not going to be able to take some of the projects, no dividend. Okay, so residual says at that point in time, if you make a 350 profit, you're not going to pay a dividend. Okay, it is not going to work. Okay. Everyone happy? Okay. I popped this diagram in because you know that there's your WACC, and at some point in time your WACC starts going up. We talked about this in the WACC section. Just remember your breakpoints in WACC, that as you raise more debt or more equity, you become more risky. Later on you become more risky, so the WACC keeps going up. Okay, so sometimes it is just a moving target. Okay, so I will always say, okay, I want that investment, that one I won't take. If I've got excess cash, pay out a dividend. Okay, are we good? Okay. Next theory. So that was all residual policy. Okay, if there's money left over, pay out a dividend. The next one is saying, hey, we've got that little thing called the dividend growth model. Okay, D1 over K minus G, and my dividend is 10 Rand, okay, times 1 plus growth over K minus G. If Gary decides, remember I said I decide this dividend. Okay, guys, cool, 10 Rand, let's make it 12. Hey, let's go for 15. So today, I decided we're going to pay a dividend of 15 Rand, guys. Maybe even, we just did mergers and acquisitions, maybe Checkers wants to buy out my little grocery store because my price is depressed. And I say, hey, I know I can increase the value of that thing over there. If I increase the value of that thing over there, that value will go up. And Checkers won't want to buy me anymore because my value will be higher. So, hey, my dividend was 10 Rand, now it's 15 Rand. 15 times 1 plus growth over K minus G. Now, all of a sudden, I'm worth more. Does that make sense? So I can increase, based on that model, I can increase the value of my company just by by increasing my dividend. Does that make sense? Yes, does it? Everyone is saying it can't be right, eh? I can see you saying, no, that doesn't sound right. And it's not. Okay. Because I can increase my dividend 15, pay out a huge amount of cash, and then you say, hey, Gary, tell me about your growth now. Are you still going to be able to open those other 3 stores? No, I don't have the money now. I paid it out as a dividend. So your growth was going to be 8%. Now it's going to be 2 stores. So you're only going to grow by 5%. Okay? So all of a sudden my growth decreases. So even though, based on that model, you can increase the dividend, it has an impact on my growth. And the theory of dividend growth basically says, if my dividend goes up, my growth will compensate for it, and my growth will go down. My growth will compensate, and it'll end up at exactly the same value. So you can choose whatever number you want. You're not going to increase this value over here because growth will rip it down again. Okay. So remember that as well. Growth and dividends always go together. If I take one, I'm going to hurt the other one. Okay. Okay, so the way this comes up normally in an exam type situation, okay, is that I will give you a question, and at some point in time I'll say, hey, the financial director, Donna, she's more into her audit than anything else, and she said, hey, we can increase the value just by going and increasing our dividend. What do you think? And you're going to tell me, no, that's not going to work because your growth is going to go down. So it'll be more in the form of that kind of, in the scenario, and then you just say, no, that isn't how it works, Gary. Okay. Okay, so that's now dividend growth. We did the residual dividend growth model. The next one is dividend irrelevance view. Okay, dividend irrelevance view it's Modigliani and Miller. Okay, it doesn't actually call it Modigliani and Miller. Oh, is Modigliani and Miller still coming? Okay. Dividend irrelevance view, it's very similar to Modigliani and Miller. It basically says as soon as you pay your dividend, you decrease growth, so you will only pay if there's no other profitable use. Okay, but they take it a step further. Okay, and this is where Steve Jobs kicks in. Okay, see, Steve Jobs said, I do not want to talk about a dividend at all because if I am paying a dividend, I have failed you, my shareholders, because I have basically said to you, thank you for giving me your money to put in my company to create fantastic products, but I don't know what to do with it. So here, have it back. That was his view. He said, no, I should have cool stuff to do with it. If I don't have cool stuff, I've failed. Okay, and there is a strong, Tim Cook, that was definitely a big issue he dealt with. Yes, I'm going to pay dividends. Oh, Tim, don't you know what to do? Okay, are you battling over here that you can't spend the money because obviously you're now failing us? Okay. Okay, and therefore, yeah, I think I've covered this already, in investment decision and financing policies. So you're going to look at your capital structure, you're going to look at your projects, which ones that you want, and basically then go back to the residual approach. Okay, so that basically comes back to the residual approach. Okay, and there's old Steve. Okay. Okay, so that's dividend irrelevance. So it's not linked to Modigliani and Miller, it's linked to the residual approach. Okay. Bird in hand, okay, is one of my favorite ones because it sounds so silly, okay, and I used to discount it and say, oh, theoretical thing in a textbook, okay, until I started seeing it come out in what, they weren't calling it bird in hand, but I saw them doing exactly that in the market. Okay, it works. Anyone know what the bird in hand is? The common bird in hand. It's like a saying. Okay, if you've got a bird in your hand, think hungry chicken. Okay, I've got a bird in my hand, I've got it. It's worth 2 in the bush that I haven't caught yet, because I caught this one. So if I've got it, it's worth more than the ones I haven't caught. Okay, put that in a dividend perspective. If I give you money in your hand, hey guys, 15 Rand dividend, there it is. The 15 Rand dividend that you're holding in your hand, that's in your bank account, feels better than the unknown capital growth that you could get because Gary could go do cool stuff with the money. This is risk. There's risk over here. I don't know if I'm going to get the 2 birds, or I don't know if I'm going to make the profit and get the growth. Whereas here, I've got my 15 Rand, I feel fantastic. I go shopping. Okay, so bird in hand basically says if you give somebody something, they feel better. This is how pyramid schemes work. Pyramid schemes, it's like, oh, no, you have to bring people in and whatever, you'll get money. And as soon as you're very skeptical and it doesn't make any sense until I put 10 Rand in your hand. You say, oh, this thing works. It works. No, I've seen it. It works. 10 Rand, fantastic. Here's another 1,000. I'll give you 100. Oh, let me get all my friends. And before you know it, we've got a whole pyramid scheme. Okay. Okay, so a dividend paid is more valuable than uncertain future growth. That's basically what the bird in hand says. Okay, and if you think about it, it's a psychological one. This is where we've moved into the non-financial ones. This is their wants and needs, as opposed to a clinical, hey, if I've got money, I'll pay it out. Okay. Okay? Counter-argument to this is that if you look at it, the dividends that are paid out, okay, they went and they did a study and they said, out of all the dividends that are paid out in the market, what happens to them? Do people take it out and do they go buy groceries or shoes or whatever, or do they put it back into the market? And they found that the vast majority of dividends is put back into the market. So all of the pension funds and all that kind of stuff, you can pay them dividends, they put it back into the shares. Okay, so for that reason, it's still kind of a case of, yeah, but I had it and I could choose to put it back in the market. But I kind of had the satisfaction of having it. Now I'll give it back to you. Okay, so maybe there's an element of that. But a much softer one. Okay. Okay, Modigliani and Miller says dividends are absolutely irrelevant. Okay, because what will happen is I will have 10 shareholders who each give me 100 Rand. Okay, if I pay, so I've got 1,000 Rand in total. Okay, if I pay out 100 as a dividend and I have all of those projects I still need to go and invest in, I'll just go and I will get another new shareholder. I will sell them a share for 100. Okay, so each one of you will now be worth 900 because you've got 100 Rand dividend. So your shares are worth 900. The new shareholder that's worth 100, and we now sit still with 1,000 Rand in our company. So Modigliani and Miller says, what we'll do is we'll pay out a dividend to the shareholders, and we'll go and raise new capital for what we need. We can give you a dividend or we cannot, we don't care. Okay, so that's basically what they say. Okay, if you pay a dividend, I'll raise the finance by issuing new shares. There'll be more shares for the same assets, therefore their share value will drop. Okay, down to 900, and the 100 will be in the hands of the new shareholders. Okay, more shares, same assets. The shareholders in the same position. They've got a share worth 900 Rand. They used to have 1,000, correct? But they've got 100 Rand in their bank account. They're in the same position. Okay, so they haven't watered down. They've now got a share and a dividend, as opposed to having 1,000 in a share. So Modigliani and Miller says it's a closed system. Don't stress. Okay. They will dilute, of course, because now they only got 90% of the company. Before they had 100% of the company. Okay, but Modigliani and Miller, you did Modigliani and Miller in capital structure as well. It's based on a whole lot of assumptions. Okay, no taxes. There are taxes. There's CGT when you sell your shares. Okay, if you pay a dividend, there's dividend withholding tax. So we can't just assume away taxes. That will affect us. Okay, there's no transfer costs. Issuing shares, very expensive to do. Okay, when I transfer shares between shareholders, there are admin costs. So that yes, just to do this thing over here is going to cause transaction costs, which is going to be a loss in the system. So yes, that's also a problem. And also that there's no market imperfections. Okay, which means, hey, I'm going to pay a dividend of 100 Rand. Okay, hey, I'm paying a huge dividend. Okay, so maybe my share price is going to go up. Okay, or if I don't pay a dividend, I decide, oh, I'm not going to pay a dividend, my share price is going to go straight down. Okay, there are market imperfections, which we'll talk about now. Okay, yes? Yes, there's a dividend section in the textbook.
Okay, and you can probably explain the residual calculations.
The residuals. Okay, I can do that. Okay, so let me go through these again quickly. It will be a refresher. Okay, so if I have a profit of 1,000, okay, a profit of 1,000, and my investments, that number over there is 800. I need 800 to take all the projects I want. Okay, I've got 1,000 available. That means I can do all my projects and have 200 Rand left over, dividend of 200. Okay, the second example was, I've only got a profit of 700, but I've got a debt equity of 1:1. In other words, I need 800 to do all my investments, okay, but only 400 has to come from equity. Okay, so 800 divided by 2, 400 comes from equity. I've got 700, so I can pay out the difference. I can pay out 300 as a dividend. Okay, that was the second one. The third one was, hey, what happens if I've got profit of 350? I need 800. 800 divided by 2, 400 from equity. I've only got 350, no dividend. Okay. Okay, we did birdie in hand, we did M&M. Okay, so M&M is, yeah, that all makes sense. Makes total sense until you start bringing in the assumptions. Okay, and then the whole thing falls over. Okay, so there we go. No taxes, no transaction costs, and market imperfections. That's the same as what's in that little bottom corner, is that piece over there. Okay. Then there are a whole lot of other things that affect it. Okay, I'm going to go through each one of those now. Legal considerations. You're going to go and you're going to look at the Companies Act. Okay, and the Companies Act has got a whole lot of things that you need to take into account for dividends. The first one is dividends comes out of profit. As soon as I run out of retained earnings, I'm actually paying back capital. I'm not paying a dividend anymore. Okay, so dividends can only come out of profit. Okay. Then there's a solvency, we've covered it just now, a solvency and a liquidity test, and your assets after the distribution have to exceed your liabilities. So I give you an example, a question. I give you a question, I give you their balance sheet, I tell you, hey, we want to get rid of this, this merger, so we're going to pay a huge dividend. Okay, you need to go and say, oh, but hold on a second, you can't just pay a huge dividend. Will you be okay? Will it pay out all your retained earnings and you'll end up starting to pay out contributed capital? Will your assets still exceed your liabilities because you're going to pay out a huge amount of cash? Okay. Is it going to affect your debt equity balance? Okay. Solvency test from the Companies Act, you still have to satisfy that. Liquidity test from the Companies Act, you still have to satisfy that. All of those things you need to take into account. Okay, and these are just those little rules from the Companies Act. I would go and flag those, okay? You don't need to, when you're determining, can I pay out a dividend? Okay, you do not need to count for the depreciation on your fixed assets. So if your profit after tax was 1,000, you can go and say, hey, add back my depreciation of, say, 100, I can actually pay 1,100 out as a dividend, because I don't have to take care of depreciation. I can reverse that out and pay a full dividend. It's basically just saying, you've got the cash, you can use it. Okay, you don't have to take into account depreciation. You do need to say, am I going to lose money on my working capital? So the next step you'd say is, okay, cool, pay out 1,100. I go and I look at my balance sheet and I see inventory, and I see receivables. Okay, and I have a look at those things in a little bit more depth, and I say, yeah, let's make it 500. But you know what? You know, it's really probably lower of net realizable value and cost. It's probably only worth 400. And my receivables, yeah, some of them are dodgy. We're in the middle of a credit crisis. I think of those 600, I'm only going to collect 450. Okay, I would have to take that 150 loss and that 100 loss and say minus 250. I have to make sure that my working capital is fairly valued. Okay, so I need to adjust for that, losses in working capital. Okay, if you make a profit in the current year, you can ignore the losses in the prior year. You don't have to make up your retained earnings. If you were still in negative retained earnings, but you made a profit this year, you can still pay a dividend. Okay, it doesn't prevent you. Okay, anything unrealized, so realized and unrealized can be available. So if you've got an asset, you go from there's your current assets, you go to your long-term assets, and you've got a property. Okay, and your property is worth 1,000, okay, on your balance sheet, but actually the market value is 2,000, okay, you can actually also pay out a portion of that as a dividend, an unrealized profit. Problem is, you'd probably have to go raise debt to get the cash, but you can do it in terms of the Companies Act. Okay. Yes? It's only depreciation. Yeah, it's not all non-cash items. Okay, there's my solvency and liquidity test. I've spoken to you about those two. Okay, and consider the value of assets. That's that little example over there of my property. I can take it into account. Okay. Okay. Everyone good? Okay. The next part is really, really important. Okay, and that is the information content of dividends. I've touched on this already with those analyst reports at the beginning, that Mark, Guy, and Sam, those two, where they said, hey, we're going to change decisions we're going to tell the market about because of a dividend. Okay, so based on everything I've said so far, if Gary can just determine what the dividend is, 15, 18, 20, let's make it 30. Okay, how valuable is the dividend? Okay. So it is a limited source of information. You've got a whole set of financial statements, hundreds of pages, income statement, balance sheet, yet I'm going to tell you that the dividend that I pay, that I get to choose, is bigger information than your financial statements. Okay. And the reason is, it is a signal of the well-being of the company. Okay. Not only have we done well, and you can see it in the financial statements, I'm going to prove it to you by giving you cash. Okay. Okay, so it's confidence about my future earnings. I said to you with Anglo-American, your share value can drop by 50% if you cut your dividend. So the last thing I want to do is show a drop in dividends, correct? It's going to do the Anglo thing, it's going to go down. I said, no, I don't want that. So I never, ever, 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 ever want to show you a decrease in dividends. So when I say, hey, my dividend is over there, and I say, hey, guys, I'm going to increase my dividend, okay, and I increase it by that much over there, and I say, there's my new level of dividends, you guys know, Gary will never just say, okay, next year, no, let's drop it. Okay, then maybe it'll drop again, and then it'll go up again. I'm not going to do this, because that over there will cause a 50% decrease. Maybe not 50, because it's not a total cut, but a huge impact. Okay. So the fact that you know I can determine this number, I can choose it. Okay. I will choose when I increase it. I'm almost guaranteeing it that that's my new long-term level. I know I can safely, very, very safely, I'm never going to have to cut it, I can safely pay that new dividend forever. Because you know I don't want to come below this line. So when I increase it, I'm telling you, hey, everything is increasing long-term, not just short-term, because I'm committing to a long-term dividend. So as soon as Gary starts wanting to go big on the dividend, you know that it needs to be sustainable. Okay. So it's confidence about the future earnings. I'm telling you it's a sustainable increase in earnings, not just a once-off. Okay, because I don't want to cut it. Okay. Okay, and I think I've covered all of that. Okay. Why are the financials less valuable? We've done that a million times. Okay. I think the big thing with dividends as well is if you think about it, how many people in the market? Okay, so if you think of investors in the market, how many investors in the market actually can read a set of financial statements? You guys can. So you almost assume that everyone can. But what about the art student who did a BA, who paints very pretty pictures, makes money, puts their money into Anglo, and you send them a 100-page set of financials? An engineer, 100-page set of financials. It'll kind of balance the table or something. It's not going to be, it's not going to be read. They can't understand it, and there are all these issues with them as well. They're too complex, all of that kind of stuff. So for that reason, when I give them a dividend, they can all, and the art student can understand a dividend. Hey, I got money. Okay, so it's much more powerful information. Okay, so I can ensure that my dividend is acceptable. You know that, okay? So you know that I will not ever want to reduce it. Okay, so if I do, and that's what happened to Anglo and Old Mutual, if I ever do say, hey guys, you know what, we've been going up nicely, we've been going up all the way along, and you know what, this year, Anglo-American, we're not going to pay a dividend. Okay, my share price is going to go straight down because you know, I'm telling you, it's a long-term decline in profits. I could choose to still keep it over there. I decide this. It's not a... So things must really be bad. So as soon as you have a cut in dividends, it's like, oi, the sky has fallen. Because it's a last resort. No director ever wants to decrease dividends. because they're trying to reassure the shareholders, saying, I know, my earnings are like that, I know that that's what they look like, but look at my pretty dividend line. That's what they're trying to show everyone. Okay, so I can ensure it's acceptable, yes, indifferent. This is the whole Steve Jobs thing. If I'm in a growth phase, I'm not going to pay dividends. So yes, I will not want to reduce it. I've explained that. Okay, I will always want to tell you, if we did do badly, so if this was my reality, and I end up down here, I will want to walk out into that results meeting, and I'll say, hey guys, we did badly this year, but we're okay. Short term, we did badly in this year. I'm still going to pay you this dividend over here because next year will be better. All of a sudden, the art student, the engineer, everyone is a lot more comfortable because they still got the same dividend or increased dividend. Even though the company did badly, they kind of forget about the bad performance. Because Gary said, no, long term we're fine. Okay, and that's what an information content dividend is trying to send. Okay. Okay, now I'm just reminding you of the potential decline. Okay, everyone happy with that? Okay, so if I ever say, hey, Donna's been looking at the financials and she thinks we must not pay a dividend this year because she wants to try something different. You're going to say, that's fine, but you realize what's going to happen. Okay, what happens when that happens? Previous lecture, mergers. Somebody's going to come and try and buy me because all of a sudden the value of Anglo-American halved. What's BHP Billiton doing? Ooh, we're going shopping. They're going to come try and buy Anglo at half the value. They know the value is far higher. They know this is stupid because the dividend just is they know it was cut for a good reason. Okay. Okay. Okay, then just taxes. Of course, there's the dividend tax. Magda, has she done taxes with you yet? That was yesterday. Okay, so she's done all the taxes. I'm not going to go through all of the detail, but for me, you just need to know what are the taxes that are applicable. For her, you can do the taxes. Dividend tax on the actual dividend, the 20%. If you go and buy back shares, everyone I buy back the share from is going to have CGT. Okay, and then it will depend. Are they a share dealer or are they holding it for capital reasons? Then it will be CGT. So it could even be normal tax, okay, if it is a share dealer. Okay. Okay, so I summarized everything over here. Income tax will be on the sliding scale, okay, if you sell your shares. Okay, companies tax, 27%. Okay, CGT, if it's a capital gain. Okay, but you might have a whole lot of exemptions. So take those into account. Withholding tax we know about, and if you're a share trader, it's normal income. Okay, there's no CGT, it's actually normal taxable income. Okay, so Magda would have done all of this with you. I just need you to know and be able to, if I say, hey, I'm a shareholder and I'm a share dealer, you're going to say to me, oh, you're going to have a bigger tax consequence. Okay, you're not going to have the CGT stuff. Okay. Oh, and then I found this and I threw it in. It's like the weirdest thing. Okay, this is all the tax rates, okay? It's for interest's sake, okay? Okay, there's my withholding tax, okay, the purple. You can see it's moved around a little bit, and now we're at 20%, okay? CGT has kind of stayed constant, but it's going up with the withholding tax, okay? Company tax is the yellow one in the middle, which has now just dropped down to 27%. Okay, my highest income tax, okay, is now 45%. Okay, my lowest income tax for individuals is down there. Okay, so you can see where a lot of the taxable income is coming from. The highest is the highest earners, then companies, but then we've still got these two. What I wanted to show you for these two tend to move together. Because what happens when withholding tax goes down, but CGT doesn't? What is the Minister of Finance trying to do when this gap opens? They're trying to encourage investment. Because think about it. If I sell my share, I pay that much tax. If I get a dividend, I pay less. So rather give me the dividend. Rather keep my money invested. So when they want to stimulate the economy, Okay, when they want to stimulate the economy, they will push up CGT, so force you not to sell your shares, and they will drop the dividend tax, saying keep your share, we'll reward you for it. Okay, and then all of a sudden there's more investment in the market. In fact, that's what we should do right now, to promote investment to drive our economy. Okay. Okay. And then while I was playing around with this one popped up. Okay. This is tax revenue as a percentage of GDP. I can't remember what was going on in my head. Okay, you can see it's quite an old diagram. And I stumbled across this and I thought, wow, that's quite interesting. Are we overtaxed as a population, would you say? Do we pay heavy tax? Okay, everyone said yes. I didn't see any no's. Okay, this is the proof. Okay, there's South Africa. How much tax do we pay as a percentage of our gross domestic product? That's where we are. Okay, the red is the high income countries. So China and the US and the UK. Okay, the entire world, their average is down here. Okay, and even upper middle countries are down here. So we definitely have an imbalance at the moment. Maybe that's because our economy is bad. Because if you think about it, when our economy improves, that as a percentage of our economy will drop. Okay, so either this is just we're getting taxed too much, or it's because our economy is underperforming. So either we need to make our economy perform better by increasing our GDP, or we need to drop taxes. Okay. Interestingly, if we drop taxes, what will it do to the economy? It'll stimulate it. So that's why often, I think it was one of the things that just stuck with me when I heard it. I think it was Reagan, Ronald Reagan. He said, I want to make more money for the government, so I'm going to drop taxes. You're insane. No, we're going to make that bigger. If I make that bigger, I'll have more tax. It'll be a lower rate on a bigger amount. And that's what they did. Okay. Okay, that's just another picture of it. You can see there that it has been increasing steadily. Okay, again, that's partly because our economy is not doing so well, but it's partly also because tax rates have been going up. Okay, so we're still on non-financials for dividends. Okay, still on non-financials. That's my little old granny. Okay, sitting there by the fire with her cat. Is there a cat? There used to be a cat. And that's my investor. Okay, that's my investor. Okay, this person here, this is called the clientele effect. Okay, and if you think about it, different companies, or let me explain it first. This person over here wants a stable dividend. They do not want you to cut their dividend. Apple is not for this person. They want a dividend. Pick and Pay is for this person. Stable dividend that keeps increasing, fantastic. Okay, this person over here, we have to be careful because this person over here wants the high growth. Okay, they're not relying on the dividend. They will want the high growth. They will be able to take more risk. Okay, so normally if you go and you look at your share register and you say, okay, cool, who are my shareholders? You'll have all the shareholders listed. You need to go and look at those and say, do I have little old grannies? Okay, or do I have mutual funds and merchant banks and all of those kind of things who want volatility, who want growth? Okay, because if I change my dividend and I drop it, so Anglo-American had a whole lot of these little old ladies sitting there, and as soon as they cut their dividend, they all said, we are out. And they sold their shares because they needed the income. Okay. One of the things that Steve Jobs said is, one of the reasons I'm cutting my dividend or not going to pay a dividend is because those shareholders do not belong with me. I'm too high risk for them. I need the risk-seeking investors. So if I cut my dividend, I will chase them away. They'll go to a better company that suits them better. They won't be with me that's exposing them to the stupid risk. Okay, if I get it right, huge profits. If I get it wrong, we're going to lose everything, and I don't want them to lose everything. So let me rather chase them away. Okay, and that's basically what you can do. You can change the profile of your shareholder base by changing your dividend. Okay. So often in a question, I will give you a whole list of, hey, these are my shareholders, this is their wants and needs, and you need to say, well, if I cut their dividend, I'm going to lose all those shareholders, but maybe I want that. Maybe I want to go into a hectic growth phase. And for that reason, I don't want the little old ladies that are going to hold me back. Okay, so that's called the clientele effect. Do you want cash income or do you want capital growth? Okay, the guy on the right wanted capital growth, the lady on the left wanted cash income. Okay, I need to look at my clientele and realize that I might just chase them away. Remember as well, when I chase shareholders away, they dump my shares. So I do get the decrease in price, so I have to be a bit careful of that. Okay, so those with income will want a high dividend share. Those that want growth will want no dividends, but they will want growth. Okay, so there we go. You may see a change in profile of your shareholders if you pay a dividend, okay, or if you change your dividend. Okay. The counter argument to that is, yeah, but the little old lady can sell her shares. She could just sell. She's got 1,000 shares. She can sell 2 and still get her income. Okay, so she can sell her shares to obtain income. They can switch investments by buying and selling shares. So if you don't like what the company is doing, create your own dividend. Okay. However, and it's just like Modigliani and Miller, yes, but there are always consequences. Okay. There are transaction costs. She's going to incur brokerage fees. She's going to maybe end up having to pay tax. Okay. I'll come back to this one. In fact, I'm going to go to that one now. Okay, so that's the first one, transaction costs. She might be classified as a share deal if she doesn't offer in enough, and then she's going to not get CGT. She's going to get normal trading income. Disaster. Okay, she doesn't want that. Okay. Shareholders may be precluded by internal rules. Okay. So that happens a lot with unit trusts and pension funds. Okay. They normally say, okay, unit trusts and pension funds normally have a mandate. Okay. In their mandate, they say you take money, okay, and you go and you buy shares. Okay. In order to do that and to pay all your people to decide what shares that you own, so this is my share portfolio, in order to do that, you need to incur expenses. Okay. And the mandate normally says you cannot pay your expenses out of the capital that you've invested. In other words, we don't want you selling shares and eroding the capital value just to pay your expenses. So, what that type of company, unit trust or a pension fund, what they normally say is we'll need some dividend earning companies in there. We'll also have some bonds in there that earn interest because those two investments will create income. And if I've got income, I can pay my expenses. So the mandate says, thou shalt not pay out of my capital. You can't sell a share to go pay your expenses, but you can use the dividends and the interest. So for that reason, even sometimes your institutional shareholders will not want the high growth share. They will rather say, give me Pick n Pay that pays a really good dividend because I have to pay my salary. Okay, if I don't have that income, I'm prevented from using that, so I can't just go with growth shares. Okay, so institutions, yes, if they have to pay their expenses, they also want income. Same as the little old lady. Okay. Okay, loss of control. You've got a company, holding, subsidiary, okay, both listed. This one starts saying no dividend, and they start having to sell some of that investment in order to earn the income that they want, and they go from 51% down to 50%, down to eventually 49%, and they lose control. Okay, so that could happen, lose control, you dilute in your voting rights. Okay, and of course flotation costs if you have to raise new shares. Okay, that kind of links back to the Modigliani and Miller argument, that flotation costs some of those expenses, so it's the same thing. Okay. Okay, so we've done that. Okay, I think we've covered all the theory now. That was a bit boring, right? So dividends can be, I think it's really exciting, but there's some boring aspects. Okay, so now I think we finished the boring. Okay, so enter Steinhoff. Okay, while I was looking at all of this stuff and looking at all the theories, I kind of thought to myself, hey, could we have, everyone remember Steinhoff? You've seen Steinheist and everything. Okay, Steinhoff crashed and burned, 100%. And while I was preparing the lecture, I basically said, hey, could we predict financial failure with dividends? Is that possible? Because we said, hey, it's a last resort. Is there any warning signal? Did Steinhoff do this nice, consistent dividend? Did they do this thing and fool everyone because nobody knew anything was coming, because the dividend was there and we trusted the dividend? Okay, that's what I wanted to see. And if you have a look at it, okay, there's still the crash. There's their dividends. Okay, have a look. So 99, they're paying a dividend of 620. Okay, they're also doing, we'll talk about scrip dividends later, 620, then they went up to 9, so we are fantastic and everyone wants their shares, 12, 15, 18, 22. So you can see they're doing nicely, hey? The shares are going up, the dividends are going up nicely, so shareholders are very happy, 30, 37, see no decreases, hey? So they're fooling everybody at the moment. Look at how my dividend is increasing. That is where Steinhoff was the golden child, because look at those increases from 6 in 99 up to 30 in 2005. I kind of want to be that shareholder. Okay. 37.5, 50, 60, 60, 63, 65. So now the increases have slowed a little bit. We used to have this huge increase. Now we're going up by like nothing. 5%, okay. Then up to 65, okay. Then 2012, up a huge amount because people started worrying and saying, what's going on? So they said, hey, they did the 15 thing. Now we'll show you how cool we are. We'll pay a dividend of 80. They paid a huge 80 again. 2014, 2015, no dividend. Okay, should that not have been a warning? There we go. It is there in black and white in their dividend history. There was very, very big signals from a dividend perspective. Things must really be bad. Not even just 1 year in a difficult COVID year or in a difficult credit crisis. 2 years where they didn't pay any dividend. When the dividend came back, that is in euros, okay, and they did a whole lot of things to their shares, but it was lower. Okay, and then they cut it again in 2017. Okay, and then after that, that's where the whole thing fell apart. Okay, so could you have predicted Steinhoff just by looking at that? Yes, you could have. Quite early, actually. You could have predicted it back in 2014, 2015, and it only happened in 2018. So back here, you could have seen that there was problems. Everyone said, no, we'll overlook it. Okay. Don't ask me how. Okay, firm life cycle we've spoken about. I drew it on the board just now. Okay, in fact, I haven't. I'm not going to go through this in detail. There's my firm life cycle. I start off and I'm growing fast. Then I get more mature and I'm still expanding. Then I get very mature, pick and pay. Then I start declining. Okay, your dividends will be different in different areas. Okay, we've done this in previous lectures. Okay, your dividend policy is the one I want to focus. In your introduction phase, you're not giving money back to your shareholders. You need every cent you can get. You aggressively growing. You're a new company. Okay. Then you're in rapid expansion. Hey, let's list this thing. Let's open up globally. Let's grow as quickly as we can. Still no dividends. Or if you do, very low, but probably no dividend. When you get to mature growth, that's when you want to start paying dividends. So increase your dividends. When you get into decline, you expand those dividends. You have a lot of dividends, including special dividends. Okay, I'll talk about special dividends just now. And share repurchases. Okay, so lots of payments, no payments. So if I say to you, hey, it's a brand new company, you're going to say, ooh, no. Based on life cycle of the business, what are their needs? Okay. Then we've got a whole lot of different dividend payment policies. Stable dividend, stable payout. I'm actually going to go to this graph over here. Okay. That's what we want to get away from. As a financial director, you do not want your shareholders to see declines, declines, declines. You want them to see stability. because stability brings share price. It makes everyone comfortable. So we will rather want that to happen. We will keep it stable, and then when we can guarantee long-term that the dividend's going to increase, we increase it. Okay, so that would be a stable dividend policy. Stable, I'll increase it when I can, knowing I'm increasing for the long term. Okay. If you have a stable payout ratio, some companies do have this. So Pick n Pay will have a stable payout ratio, but their income line looks like this already. So they don't have to worry. Okay, they've already got stability. But that, you'll see, mimics that 100%. So therefore, you probably you're not achieving anything with your dividend. It's exactly the same information as your earnings. So that's the one that we normally prefer. Okay. This one over here with the little bumps, okay, is where you have a stable dividend with a bonus or a special dividend. That is where you're trading along and you say, hey, you know what we're going to do? We're Anglo-American. Let's unbundle Mondi. We did it in the last lecture. Let's unbundle Mondi. We'll get some money in, and then we'll sit with 500 million rand on our balance sheet. We know that 500 million on our balance sheet is a bad thing because it's lazy cash. It's earning interest. I need to earn my whack for my shareholders to be interested, so that 500 million, either I need to use it somewhere. If I can't use it somewhere, let me give it back to the shareholders. Otherwise, I'm on the back foot. I'm earning a low return on my biggest asset. I don't want that. Okay. So I pay it to you guys as a dividend, but I call it a special dividend, okay, or a bonus dividend. And what I do is I say, hey guys, this is not my ordinary dividend. This is due to the transaction of selling Mondi. I'm giving you a bonus. It will not recur. Okay, so I'm basically saying you cannot guarantee that this is going to go on forever. I'm telling you it's going to go up and it's going to come down again. So I'm not committing myself long term. Giving you the money and then I'm saying, but status quo. Okay, that is normally what happens when you have excess cash from a specific transaction. Okay, if I had to say, hey, we sold Mondi and we go up like that, and then the next year I say, oh, no, we didn't sell Mondi this year, so we're going back to our old dividend. Now I'm sitting with a decrease and everyone cries. Okay, all the shareholders get upset, my share price goes down. So I need to make sure I communicate properly. This is a once-off. Okay, so that's the last one, stable plus a bonus. This is what most companies do. Okay, cool. Types of dividends, okay, what are the different types? The cash one we know, okay, it's just a cash dividend. These are some of the alternatives. Oops, there's my cash dividend at the bottom. Anyone know what a capitalization issue is? Okay, I'll use an example. A cap issue is normally where I say, hey, you know what? And it's very similar to a share split. I've got 1,000 shares. You guys all have a share. 1,000 shares, 1,000 shareholders. And I say, oh, I'm going to issue all an extra share. So I issue each one of you an extra share. Now I've got 2,000 shares in total. Okay? And each of you, my shareholders, have 2 shares, whereas before you had 1. Before, your shares were worth 2 rand each. Okay, the company is still worth 2,000. 2,000 divided by 2. Now your share is worth 1 rand each, but you've got 2 of them. So it's made no change. Okay, a capitalization issue is literally just saying, hey, you had 1, now you've got 2, but your value is exactly the same. Okay. That is the same as a share split. I'm going to split the shares, and I'm just going to say, hey, you had 1,000, now you've got 1,500. I split the shares, but your value hasn't changed. Okay, so both of those don't really add any value. Okay, there is an argument that it makes them more tradable. Okay, if I said to you, hey, my share is trading at 380,000 rand per share. Okay, how many shareholders can go and buy 1 share in my company? If I say, hey, let me have a share split and let me take away all those notes or a capitalization issue and let me give them 10,000 additional shares, and now the price is only 38 rand, will I be able to get more shareholders? Yeah, everyone's prepared to buy 38, Okay, and they just get a smaller portion. So if you're sitting with a huge share price, then capitalization issues or share splits are very attractive. Okay, but that's pretty much the main use. Scrip dividends were very popular. I'll show them to you now. Scrip dividends is where I say, hey, guys, do you want cash? I'll give you 50 Rand, or I will give you another share instead. What do you want? And each of you gets to choose, and you choose whether you want a scrip dividend or to get a cash dividend. Okay. This is almost, it's historic for South Africa, but I suppose it's different in different countries. It all goes back to CGT versus dividend withholding tax. Okay. When they first brought in CGT, okay, when they first brought in STC came first. Secondary tax on companies was a tax on a dividend. Okay, so everyone said, oh, no, we don't want dividends now, we're going to get taxed on it. So keep your dividends, we don't want them. I said, yeah, but I need to give you something. I'll tell you what, I'll give you a share, a scrip dividend instead. You won't pay any tax on it because you're not getting cash. Okay, only when you sell your scrip dividend will you realize profit. And when you sell your scrip dividend, okay, I don't know. I think a scrip dividend is still going to be subject to withholding tax, but Magda will do that with you. But the bottom line is it was a tax reason. Okay. As I showed you, CGT and dividend withholding tax are moving together so that we're not seeing that difference in decision based on a tax reason. Okay, share buybacks we're going to do just now, and I think we know the cash dividend. Okay, so we've covered this. There's my notes, cap awards, share split. Okay. There's my affordability and liquidity. That's my 380,000 versus my 38. That's that piece over there. Okay, they do not affect the value. Okay, there's my scrip dividends. We talked about there's my different taxes. Okay. Dividend reinvestment plan is the same as a scrip dividend. I said, hey, do you want to have a dividend or do you rather want to reinvest it? And then you could choose and you'd get a bigger portion of the company. So that's just notes on that. It's the same as a scrip dividend. Share buybacks. Okay. Share buybacks is when you buy back your company, your shares from your company, and from your shareholders, but the company buys back the shares. So you literally are buying your own shares back. Okay. Why would you want to do this? Okay. One of the defense things that we talked about in mergers and acquisitions was go and buy back your own shares. Okay. If Apple announces, hey, guys, we're going to buy back our own shares, okay, do you think it's a positive information signal to the market or a negative? Who knows the most about Apple? Apple, the directors. If they say, we have looked around, we thought, should we make a new device or should we just buy back our own shares because we think our shares are that good? We'll just buy back our own shares. It's a very strong piece of information saying we think that's the most attractive investment we can find on the market. So buying back shares is a very positive information signal. Okay, and then for that reason, it normally does increase the share price. As soon as you announce a share buyback, you normally have an increase in share price. It also kind of suggests that you have cash available. Okay, so if I've got too much cash, just like Apple has way too much cash, it's a good way to get rid of some of that cash. Okay, so if I've got too much, buy back your own shares. Okay, it also helps me to fix my capital structure. I've rubbed it out with my little diagram that goes like that. Okay, if I've got too much equity, I've ended up with too much equity and I've ended down this side, I just sell some of my shares, it'll take me back up there. Okay, I decrease my equity, it'll take me back to my optimal capital structure. So it's one of the ways to make that adjustment. Okay. If I buy back shares, the existing shareholders get more earnings per share. Okay, and more return on equity because you own a bigger chunk of the company. Less shares, same earnings, fantastic. Okay, just remember though that it might compromise your growth. Okay, we spoke about the growth and the dividends. The same thing would apply over here. Yeah, but now I can't use that cash. So if I've got surplus cash, makes plenty of sense. If I'm not going to be able to take some projects, not so much, because then it will reduce my EPS and ROE, because I have to forego some projects to buy back my own shares. Okay, that's the one I started with. It signals that management thinks my shares are cheap. Management is never going to buy back their own shares when they are too expensive. They're always going to buy back their own shares when the price is depressed. So that's why in a merger, somebody runs up and says, hey, I want to buy your company now because your shares are too cheap. I'm going to buy back some of my own shares. Will push the price back up because I'm saying, hey, they're undervalued. Okay, and that's one of the things that we can do, but it must be proactive. It can't be reactive. The Companies Act will stop you from doing that once there is an offer. Remember that affected transaction thing. Okay, increased share price I've spoken about. Control, I think we've spoken about that you can gain control, buy back some of your shares and give one of your shareholders control. Hostile takeover I've spoken about. Tax, yes. And flexibility. Okay, that flexibility side is if I do buy back some of my own shares, again, remember that it affects my borrowing capacity. So if I do change my debt-equity ratio and I decrease my equity, maybe I'm going to have to pay back some of my debt, or maybe the next time I go to my bank trying to get debt, they're going to say no. Because now all of a sudden I've moved on my diagram, I've moved down that way, okay, on my debt-equity ratio. Okay, and I think we've covered all of these already. Signaling, yes, it's a very positive signal if I buy my shares back. Okay. Flexibility I haven't spoken about yet. Okay. The biggest advantage, so if I said to you, and I give you a question saying, hey guys, should you pay a dividend, okay, or should you buy back shares? You've got excess cash, you Apple, which one should you do? Okay. With the share buyback, okay, we say, hey, we announce to the market, we're going to buy back 10 billion rands or dollars. Let's make it Apple, $10 billion of our own shares. Okay, I can now do that. I've announced it, okay, and I can go and buy them back as I want on the market when I feel like it. Don't have to do it all in one go. If the share price goes up and I say, oh, they're too expensive now, then I just won't buy them. When the share price drops, I'll go buy a whole lot. So I can go and buy them and pick and choose. If I decide by the end of the year I'm not going to buy any, I don't spend any money. What happens with the dividend? Hey, I'm going to pay you guys a 10 billion dividend. It goes out. On the payment date, my 10 billion is gone. No flexibility. Okay. So if you don't know what your cash needs are, okay, you're going to say, hey, not the dividend. The dividend is fantastic information and everything, but the money's gone straight away. If I'm not sure my cash needs, rather do a share buyback. Gives me a lot more flexibility. Okay. Tax we've spoken about. Control we've spoken about. Share price undervalued we've spoken about. And capital structure management I've been through. So that's just notes. Okay. So there we go. That's what I was saying. Share repurchases preferable when I'm not sure about my future cash flows. Okay, when my future investment needs. So I will say, hey, Donna wants to pay a dividend, or she's thinking about a share buyback, but she's got a couple of projects that she's thinking of, and she doesn't know how much and when she's going to need that money. Okay, dividend's not for you, Donna. You should do a share buyback because your future investment needs are uncertain. Okay. Okay, then prices underrated we've spoken about, CGT we've spoken about, and timing. So there's a bit of repetition in these slides on the different things. Okay. Oh, and interestingly, do you remember when Steinhoff crashed? 2018? So be careful of share buybacks. I said to you, share buyback, fantastic information. Hey, I want my own shares. That's how positive I am about my company. Share price goes up. In 2017, October, just before the crash, Steinhoff announced that they're going to buy back their own shares, and a huge amount. This whole thing was smoke and mirrors. Okay, this was at the worst, and they said, guys, I know they're shouting at me, nothing is wrong. In fact, I'm going to take 4.7 billion rand that I've got right now, and I'm going to go buy back my own shares because you have pushed my share price down. It's wrong now, I'll buy the shares. Okay, maybe not. Okay, so this was really just trying to fool the public. Okay, so be careful as well that it can be used in a less desirable way. Okay, couldn't believe it. I mean, that, yeah. And the thing about this, the flexibility thing, this wasn't a dividend where he actually had to pay out 4.7 billion. He never did this. Get the news, get the information, try and let's buy some time, but I never have to spend my 4.7 billion. Okay, because I choose. I got the flexibility. Okay, and there you go. There's just after that announcement, there you can see, like a month later, boom. Everything's okay, guys. No, it's not. Okay. Okay, I think we're nearly done. Sure, there's a million slides here, hey? Okay, we're nearly done. Okay, subsidiaries. Okay, if you, okay, there is a part of the Companies Act, okay, holding company, subsidiary. Okay, the subsidiary can go and buy shares, part of your buyback. Most companies, when they buy back their own shares, they buy them back via a subsidiary. So their 100% owned subsidiary buys shares in the holding company. Okay, so you have a cross-holding, essentially. They are allowed to do that up to 10% of the holding company's shares. Okay. The nice thing about this, if holding company buys back their own shares and they buy back 100 shares, the accounting for that is cancel the shares. You used to have 1,000, you bought back 100, now you have 900, and that's your new reality. That's gone. You paid it back, now you have 900 shares. Okay. When you buy through a subsidiary, okay, that stays as 1,000 shares. They buy back the 100 over there, and they hold them. They hold them in a treasury account. They're not allowed to vote. I think it says that they're not cancelled, but they're non-voting. So they can't buy shares and then go vote in the AGM. They're not allowed to. Okay. But they can hold them, and if they decide later, oh, you know what, we need some money, let's now go and sell them again. They can do that. They can actually hold it as an investment and trade, buy and sell. So that is a lot more attractive than having to just cancel them and then the money is gone. Here they can always access the money by just selling the shares again. Okay, so that there is how most companies do it. If they're going to exceed the 10%, then they'll have to do the normal cancel thing. Okay, so up to 10%, the treasury shares can be sold at a later state. Okay, and that's just the mechanics of it, not cancelled, but they have no voting rights. Very useful for BEE transactions because you can buy them in that entity over there and then do your BEE structuring down here. Okay, so that is very, very attractive from that perspective. Okay. Okay, then I think we've looked at this to death. Oh, okay. This was just showing you an overall, this is what Apple's been doing. There is their buybacks, okay, open market purchases, there's their total purchases and buybacks. There's their dividends, okay? There's the total capital they've returned to the market in dividends and share buybacks, 740 billion. Okay, so you can see there, and then they just explain. I just wanted to show you how much of this that they are doing now. And it's because they ended up with that huge amount of cash, and they basically said, we can't do this. It's lazy cash, we need to get rid of it. Huge share buybacks, huge dividends, to give the money back to the shareholders. Okay. Microsoft, you can see as well doing lots. So it's not just Apple. Microsoft doing lots of dividends is the gray. You can see that Microsoft's dividends going up nicely. Okay, and then share buybacks, you can see the flexibility. You don't have to maintain it at any level. Nobody cares. Okay, if you announce the share buyback, you get the positive information, and you can do it when it's convenient. Okay, whereas the gray, the dividend has to stay increasing, otherwise your share price pays. So if you're worried about your share price crashing, share buyback, not dividend, because your dividend has to stay at its level, information content. Okay, Apple is by far, or from this article, they were doing by far the most repurchasing, but you can see it's quite a common thing, share repurchases, everybody's repurchasing. Okay. Cool. Guys, we are nearly done with the lecture. Okay, so let me quickly recap. This is your summary of everything. Okay, From the purely analytical perspective, so not the information content and all the softer issues, okay? The first thing is dividends don't matter. Okay, if the little old lady wants to sell her shares, she can sell them and she can make her own dividend. So dividends don't matter, but of course there's all of those assumptions, no tax, no transaction costs, etc. So it doesn't really work. Okay. Dividend growth model, we can increase the value of the companies just by paying a dividend. No, but it rebalances. Remember, it rebalances, the growth decreases and the dividend increases. We end up with exactly the same value. Okay. Modigliani and Miller was the same as the homemade. Residual approach, only if there's money left over. If there's money left over, by all means go pay a dividend, but if there's not, you don't. Okay. Then there was the harsher version of that. If you actually are paying a dividend, that means that you can't find stuff to invest in and you're giving the money back to me, you've actually failed as management. That's Steve Jobs saying, hey, you should be spending the money. Okay. Tax we've spoken about, and then all those legal requirements, solvency and all of that. So if you get a dividend question, and it's a broad dividend question, a strategic one, make sure you've covered all of these issues. Okay, they will all be embedded in the scenario, just like a strategy question. So I'll tell you a little bit about their solvency, I'll tell you about their what their tax situation is, and then you'll grab onto that and then you'll write your point. Okay, we'll see it in the tuts. Okay, then we go to the non-financial. Hey, it's cool to have a dividend because bird in the hand, better than two in the bush. Okay, it is strong, strong information. Why? Because it's cash. I can't lie with cash. Steinhoff couldn't pay a dividend. They actually had to cut their dividend because they never had the cash. That's why they didn't pay their dividend. If he could have still paid the dividend, he would have. But he literally ran out of cash to pay a dividend. Okay? So it's strong information. Plus I'm saying, hey, if I increase it now, I'm increasing it forever. Because you know I'll never, ever want to decrease it. If it does increase, wow, the sky's fallen. Okay, it's the end of the world. You know it's the last resort. Okay. They can be managed. I get to decide, so just remember that. Okay, I've spoken about that. Limitations of the financials normally pops up. Why do we care about a dividend? Why shouldn't we look at the 100 pages of financials? Yeah, but BAs and engineers and complexity, and they can be manipulated and blah, 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 blah. You tell me why the financials aren't that valuable from a decision-making perspective, or why dividends are also relevant. Okay, then the clientele effect, well, it depends what your needs are. Are you the little old lady, or are you the company that has transaction costs that has to pay them out of income? Okay, so you can't sell the shares and get it out of capital growth. You have to have dividends. Okay, cool. The unit trust will have to have some dividend earning stocks. Okay, tax, institutional rules I've spoken about. And of course, the issues of control. Are you going to lose control? Okay. And then the alternatives, scrip dividends. Yes, I give you shares instead of dividends. Bonus or special, normally a combination of stable dividend, bonus. Stable dividend, bonus. Okay. Capitalization awards, no real value, just increase the number of shares. And share repurchases is normally a much bigger alternative. Hey, that makes sense. Flexibility, all of that kind of stuff. Okay. That's kind of the whole of dividends in a nutshell. Okay, cool. Sorry, guys, that was very long. I was going to say something about Magda, but let me not. She's going to hunt me down and get me. Eh? Okay, guys, so no break, eh? We can just carry on. No, let's do a break. How long do you want? How long do you want? 10 minutes, okay. So I've got 19:13. Let's just make it 19:25. It's 12 minutes. Okay.
So when the company issues the capitalization shares, so say this year we say we've got 1,000 shares, and then we say for everyone that has a share, we'll give them an extra share.
Yeah.
So then it multiplies to 2,000 shares, right?
Yeah.
And then let's say we've already said that our dividend is now set at 15 rand. Does that mean that for the next year, if I only had one share, I'm now going to get 30 rand?
Yes.
Okay. So does it then not affect the business negatively then in the
If you pay out the cash.
in the long run if you are now paying out the dividends? Because effectively if you are only going to pay out
Yeah.
15 rand, now you pay out 30 rand. Is that
Yes.
right?
So normally the so hold on, say that again. You were going to pay out 15, now you pay
15,
out
now
30.
you pay 30 because now initially I only had one share in the company, but now I
Okay.
have two after the
Oh, no. So
capitalization.
the dividend will adjust. So normally what you'll see is the dividend will drop, but it won't hurt the company because we'll know that the equivalent shareholder still has the same
Same,
effective
okay.
dividend. So no, it doesn't
So they will
affect.
then drop it
Yes.
to make up. Okay.
Yes, so it'll be qualified. Hey, it's not a real drop.
Okay. All right.
Okay,
Makes sense.
cool.
Thanks.
So what I'm actually thinking is there's actually a whole lot of studies on dividends where they test it. They actually go and they create portfolios, and they say on average when we buy a share on declaration date, do we make a profit, or on payment date, do we make a profit? Let's see if we can find a study that actually gives us evidence. So I'll check it and we'll look at it in the next lecture. But that's an interesting one. Yeah, cool. Okay. Okay, cool, guys. So what we're going to do is we're going to do the mergers tut. I just want to remind you, okay, that all we're trying to do with the merger when we're doing these calculations, okay, is we're trying to determine, you do have my sound, hey? Yeah. We're trying to determine what is that share exchange ratio. If you're going to get a share in my company, okay, how many shares do you get? Okay, so we said that is done by this formula, MPT, what's an M? MPT over MPS, and then I either add the synergy at the top or at the bottom, depending on who's going to get the synergy. If the target company is going to get the synergy, I add it at the top. If the acquirer company is going to get the synergy, I add it at the bottom. Okay, and that gives me my maximum and my minimum, and that's where I negotiate from. Okay, but it's as simple as that formula. Okay, and then the rest of what we're going to do in the questions, I just want to remind you of these formulae over here. They should be very, very familiar. Okay, it's just your dividend growth model. Okay, the two formats of it, either solving for price or solving for your discount rate. Okay, and then your capital asset pricing model. We're going to use those as tools. Okay, but I'll show you as we go. I'll show you. Remember, this is just determining, that one over there is determining the value. Okay, and remember I did on the board, I said, hey, in these questions, I'll often have to turn an earning into a value or a value into an earning. That's what I'm using these models for. So you could use a dividend growth and solve for that, okay? Or I could say to you, hey, do me a PE ratio or do me a discounted cash flow. This over here is basically just saying use a valuation model. Okay, but we'll do different examples in the different questions. Okay, so let's look at the first. The first one is very, very simple. Okay, it's just the basic one. So 17.11. Okay, AB wants to buy TT. It'll take place through the issue of shares in AB. Okay, so AB buying TT. All the shares in TT are going to go to AB, so they're going to become a 100% shareholder. Okay, and TT is going to get new issued shares in AB on the side over here. How many shares? That's what we want to determine. Okay. Okay, they've given you information. They've given you earnings per share. Okay, they've given you market value per share. Okay, I did say at the end of the lecture as well, the majority, 99, no, it's actually 100. 100% of the transactions I've seen have been using market value. Because remember, you could do, instead of doing MPT, you could do EPST over EPS A and add the synergy. And I said to you, yeah, but that doesn't really happen. I've never seen it. So theoretically it's there and I needed to show you, but we're going to use market value. Okay, so I've got the market value. I can already do this part of the formula. This part of the formula over there. There's MPT over MPA. 41,8 over 17,6. Okay, so I've got the first part of the formula. The last thing I need is the synergy. Okay, if synergistic benefits will increase the post-merger market value, so it's a market value synergy, okay, by 1.2 million rand, what exchange ratio will TT wish to attain in order to capture the total benefit? So TT wants the total benefit. In other words, I'm saying MPT plus synergy. They want the total benefit over MPA. And that's what I've done over there. Okay, 41,8 over 17,6. I give them the total synergy. Okay, so there I give them the total synergy, okay, which is the 1.2 million. Okay, 1.2 million, but it is per share. So I have to divide it by 500,000 shares. Okay, and if I do that calculation, I will get to the exchange ratio. Okay. Okay, at this point, I just want to pause for a second. Okay, so we've got the one company, okay, the acquirer, buying the target, okay, and then we've got these synergies. Okay, do you remember, I touched on it, okay, we're going to do it a lot more over here. What could these synergies be? Okay, these synergies could be, hey, if I join the two companies together, Standard Bank, Nedbank, I could get rid of some branches. I could sell the assets. In other words, I could get to the point where I've got 1.2 million rand that I can literally take out of the business. So now the company, when I join them together and I can sell those assets, I've got a synergy of 1.2 million in market value. It's T0 right now. I've got the money from selling those assets. Okay, so that is a market value synergy. Okay, the second synergy I can have is to say, hey, I could increase my earnings. I could take the products from the one company and sell them through the other company and make more revenue. Or I can get them together and they can get cheaper debt and we can reduce our costs. So this over here would be a earnings synergy, okay? And if that was, say, 500,000, it would be per annum. That is an earning. If I have an earning synergy, I have to turn it into a market value, okay, before I can add it. Because remember, everything in this little formula over here is market value. So I can't add an earning on as a synergy. I have to add a market value. How do I get it to market value? I'm going to either use that thing over there, or I could use PE, or I could use discounted cash flow, or any one of my valuation models. But I've got tools. I've got tools where I can turn an earning into a market value. Okay. The third synergy I can have, okay, is a decrease in risk. So when I put the two companies together, they can cross-guarantee each other's debts, and the risk of the company as a whole goes down. In other words, their cost of equity goes down. Okay, so something like a cost of equity decreasing by, say, 1%. Okay, the other one that goes with risk is, hey, my growth might increase. If I put the two companies together and they've got complementary assets, maybe my growth is going to increase by, say, 1%. Again, I can't just go and add 1% risk to as a synergy over here. I'm going to have to convert it into a number. Okay, and that's what I'm going to show you now. Okay, so everyone understand that there's the three different types of synergy. Okay, so let's go look at 1721, and I'm going to go through the whole question with you. Okay, 1721, macro and micro are manufacturers of similar products. Okay, that is important. They're manufacturers of similar products. That means their businesses are similar. Okay, so therefore they've got similar risk profiles and that they can integrate. They summarize profit and loss statement. Okay, they get that. And they give me a profit and loss and a statement of financial position. Okay, think back to your valuation models. Okay, dividend growth, PE, discounted cash flow. Okay, do I need the information revenue in any of those models? Okay, I can use it in the discounted cash flow, but ultimately I get down to the bottom and the important number is my profit. So my profit number is important. If I do use a dividend growth model, my dividend number is important. Okay. So when I'm doing a merger, the first thing I'm going to do is I'm going to say, okay, cool. I'm going to summarize the information. Okay. I'm going to say I'm going to write down macro, I'm going to write down micro, and I'm going to put down merged. Okay. And I'm going to summarize all the information that I need, and I'll explain why as we go. So the first thing I had was profit. Okay. What was the profit? The profit was 4,800. Okay, so let's put that down. 4,000 over there and 800 over there. We don't know what the merged firm is yet. Okay, Dividends 2,800. So I put down as well because that might be relevant. We don't know if we need it yet. Dividends 2,800. Okay. Just a little, what you're going to learn to do as we go is you're going to say, okay, cool. Is there a ratio I can work out that might be useful? What about your payout ratio? Okay. What portion of your profit do you pay out as a dividend? Okay. 2,000 over 4,000, I pay out 50% of my profits as a dividend. Okay, 800 over 800, I pay out 100% of my profits as a dividend. Okay, purely dividend payout ratio. That's all I calculated. Okay, let's go back to the question. Okay, then they give me my statement of financial position. Do I really use that stuff? Non-current assets, net current assets, share capital, retained earnings, all of that. That's kind of my answer. Remember, your T0 cash flow is the value of your assets or the value of your company. So none of this stuff over here actually goes into evaluation. Okay, so I don't really need that information. It's nice to see, but I don't need it. Okay. Number of shares. Remember that this thing over here, when I do MPT over MPA, that is market price per share. So yes, definitely valuable. Okay, number of shares. Okay, I probably will need that information. 5 million and 2.5 million. Okay, so I'm going to put 5 million and 2.5 million. Okay. Okay, on 30th of November, each company paid a dividend. Yeah, that's fine. The current market value of macro is R4.20 per share. Okay, so let's put that down. Market value has to be valuable. So market value, or let's make it market price. Price per share, R4.20. Okay. Okay, so that's my R4.20. And then they say for a number of years, the directors have followed a policy of retaining and reinvesting 1/2 of the company's net profits. Sentence, the company retains half of their profit. Yes, that's a payout ratio of 50%. So they didn't really have to tell me that. I could see it from the financials. Okay. Okay. This has resulted in both net profit and dividends growing at a compound rate of 5% per annum. Dividend growth model, I need a growth rate. Fantastic, okay? So let's put down growth. Growth for macro, 5%. Okay. Okay, the pattern is expected to continue indefinitely. Fantastic, okay. Micro earned a constant level of profit for many years and is expected to do so. Okay, so we're not seeing a decline. They think the 800 is going to continue. They've recently started distributing all net profits. Yes, we saw that. You distributed the full amount, 800 of 800, a 100% distribution, so that's fine. So they distributed all net profits, okay? They intend to do that if they don't get purchased into the future. Okay. The market value is R2 per share. Fantastic, I need that. R2 per share, the market value. So if I read right now and I said MPT over MPA to get an exchange ratio, I can already do R2 over R4.20. I've got that information already. So now I just need what is the synergy. That's all I'm looking for if I'm doing a merger. Okay. Okay. The directors of Macro are considering whether to submit a bid, so they want to buy them, for the entire share capital of Macro. They believe if the bid succeeded, the combined net profit would increase immediately by 1.2 million per annum. Okay. So let's draw a little picture. Let's do it down here. Macro. Okay, I know what each of these companies is worth because I've got the information at the top there. One of the synergies that they're going to have is a 1.2 million per annum increase in earnings. Okay. If I have a 1.2 million increase in earnings, I cannot plug it into that information yet because that's market price, my synergies and earning. I need to turn my synergy into a market value first. Okay, but we'll get there. Okay. Okay, so that's my 1.2 million per annum. Some of the non-current assets, like joining two branches and selling assets, some of the non-current assets would no longer be required, could be sold immediately for R1 million. Okay, cool. So I will have R1 million, R1 million in cash right now, T0, so that there is market value. Okay. That there is the same as the market value there. I could plug it in. I just have to make it per share. Okay. But the market value, that one is okay. Okay, so now I've got two synergies. Okay. The cash would be needed to generate the increase in combined profit. Ooh, okay. So now we've got a problem because we say that we've got R1 million in extra cash, but we need that R1 million to generate the 1.2 million per annum. So now we can choose one or the other. We can't have both. If I take the R1 million out, the 1.2 million goes. Okay, so I can't have both. So there's not really two synergies over here. I'm just taking assets and I'm selling them. I'm using that R1 million to generate the earning synergy. So this market value one is not really there. Okay, it's those assets. Just like all of these assets over here, okay, are needed to generate this, the R1 million I have extra over there, the R1 million I have extra over there is needed to generate the 1.2 million. So I say, okay, cool, the 1.2 million is the one I'll take. The value of the assets will include the R1 million once I'm finished. So I'm going to only use the 1.2. Okay, I can't put both. The one's used to create the other. Okay. Okay, so that's fine. The directors believe that the takeover would result in a reduction in the company's risk. Okay, and that therefore the required return of macro would fall by 1%. Okay, so if I go back to that little note that I had, that would be my risk. That's that thing over there. That's this thing over here. It's my risk decreasing. Okay, so say, okay, cool. Now, second synergy, because the million's gone, a 1% decrease in cost of equity. Okay, we go back to our information over here and we say, yeah, but we don't have a cost of equity yet. Okay, so we can't, 1% minus what? We don't have anything to deduct it. The directors of macro will continue their present policy of retaining and investing 1/2 of profits. In other words, I can go back here and I can say they're going to retain this strategy over here. Okay, so therefore, in the merged, sorry, not that. They're going to retain that 50% payout, which means for the merged firm, they will pay 50% of their profits out. So I know what the merged firm amount is. Sorry, I picked the wrong one. Okay. So present policy, retaining and investing 1/2 of profits. Okay. They believe that the compound rate of growth for both dividends and net profits of the enlarged company will be 5% per annum. Okay, do we have a growth rate? We do. They gave us a growth rate of macro. They didn't give us a growth rate of micro. But we've got one for the merged firm once they're combined. It's still going to be 5%. Okay. Everyone happy? Okay. So all we've done so far is we've summarized the information. Okay. And as I say, I'm going to say to you, hey, let's think about our tools. Okay. What we can use over here to get to the point we want to get to. Okay. So we know we have the 2 over the 4,2. That's a given. We've got those two. We just have to quantify the synergy. There's two synergies, 1.2 million, okay, in earnings, okay, and then that one is okay. I could go and work out what that is using the dividend growth model, correct? I could turn the 1.2 million into a dividend, yeah, because I know 50% of it is going to be paid out as a dividend. So half of the 1.2, okay, will give me 600 times 1 plus growth, 5%, got that, divided by K minus G, my G is 5%. I don't have K, correct. I'm missing K. So I say, okay, cool. So I'm missing K. Let's go back to our formulae, okay? There's two ways I can calculate K. Did they give me a risk-free rate? Now, okay, shouldn't. Of 15%. Okay. So I go back and I say, okay, cool, cost of equity, 15%. Okay. A merged company that the cost of equity is 1% lower than the cost of equity of macro. So therefore, the cost of equity over here will be 14%. Okay. Okay. Everyone happy? So I didn't have a cost of equity. I could work out for macro, and I could take 1% off and give me the one for micro. Sorry, for the merged firm. Okay. Okay, now I sit back and I say, okay, cool. Now I've got a cost of equity. Now I can use the model. And I say, but hold on a second. This over here, this 1% decrease in cost of equity, they said that was for the group as a whole. Okay. What happens when I take a group and each company and I discount the cash flows by a lower percentage? What happens to the value? So if I took the 2,000 that's over there and I discounted it by 14% instead of 15%, what happens? The value gets bigger. Okay. If I take, we don't know what the actual amount is, but we assume it's lower, the 800 okay, over there. And I discount it by a lower percentage because it's now in the merged firm. That means that that's going to get bigger. And the 1.2 million, that is this synergy over here, discounted at 14 versus 15, means it's also a little bit bigger. Okay, so now I have a dilemma, because if you think about it, my synergy, I want one little synergy number to add at the top or the bottom. Okay, now my synergy is that little piece, and that little piece. Okay, so how do I quantify all of that? Yes?
Why the 5,000?
Sorry?
Why the 5,000?
The 5,000 is because it's the number of shares. It was 5 million shares. I'm just working in thousands. So the 5 million shares. Okay, so that's where the 5,000 comes from. Okay, so can you see the dilemma? All I need to do is, my task is very simple, okay? All I want to do is I want to add synergy over there, but now my synergy is made up of multiple pieces. So now what do I do? Okay, so I say to myself, okay, is there an easy way to do this? Okay, do I know what? Okay, do I know what the value of macro is? The value in that box. Do I know what that value is? It's 4.20 times by 5 million shares. Okay, cool. So I can work out that box. Can I work out micro? I can. 2.5 times 2. So I can work out those two. Okay. Can I work out the value of everything? Well, let's actually take it all the way around. The value of everything. The value of the entire group. Synergy, micro, macro. Okay? And using one of our tools, could we combine all of our earnings into one amount? We know this is 14%. We know that's 5%. So we got that information. Can we get to the dividend? Yes, because we know the earnings, the earnings of macro is 4,000, the earnings of micro is 800, the earnings of the synergy is 1.2. So I say, okay, that's fine, let me add them all together. Okay, so earnings of the group, okay, macro was 4,000, micro 800, synergy 1,200, okay, gives me a total of 6,000. Everyone agree? Okay. I pay out 50% of that as a dividend. Okay, so that means my dividend is 3,000, 50% of that amount. Okay, cool. That's my D naught though. I need my D1. So let's do the little formula. P naught is equal to my dividend, 3,000, okay, times by 1 plus my growth rate of 5%, okay, divide that by my cost of equity, 14%, the 15 minus 1, minus 5%. Okay, let's do that quickly, make sure it works. Okay, 3,000 times 1.05 gives me 3,150. Divide that by 0.09. Gives me 35 million rand. Okay. That means that that entire thing is worth 35 million rand. Macro, micro, synergy, 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 synergy. All of that is worth 35 million. Then I say, okay, cool. Well, if that's worth 35, I know what macro is worth. I know what micro is worth. Let me just deduct them. And what I'll be left with is the synergy, correct? Yeah. So 35 million less macro. Okay, macro was 4.2 times 5 million. 4,2 times 5 less micro okay, was 2.5 times 2, or let's do it the other way around, 2 times 2.5, okay, so that will give me 5 million. 4.2 times 5, 4.2 times 5, gives me 21. 35 minus 21 minus 5 gives me 9 million rand. So in other words, the synergy is worth 9 million rand. Okay. And then we say from there, okay, cool. So all I need to do now is, there's my 2, my share price, divided by 4.2, MPT over MPA, plus 9 million, okay, but because it's the target, divided by 2.5 million shares will give me the maximum, okay. Should we do the calc quickly? So my maximum, 2, 0 over 4.2, they're going to get the full 9 million, okay, but they have 2.5 million shareholders that have to share it, okay, divide by 2.5 million, okay, so let's do that, okay, 9 divided by 2.5 gives me 3.6, plus 2 gives me 5.6, so that ends up being 5.6 divided by 4.2, divide by 4.2 gives me 1.3 recurring shares. So in other words, for every 1 share that the target shareholders have, I will give them 1.33333 shares in my holding company for them to keep their 2 rand share value and to get the entire synergy of 9 million. That's the correct share exchange ratio. Okay. If I want to do the minimum, I'm going to do 2 over 4.2, okay, plus 9 million at the bottom, okay, but divided by the number of shares in the 5 million, okay, divide by 5 million, okay, and that will give me, let's do it down here, 0.3 recurring. So therefore my range is the target shareholders will want to give 0.3 shares, 0.33333. The acquiring company will want to give 0.333. The target company will want 1.3333. And they will negotiate between these two numbers. Okay. Questions? Okay. Is it easy? No. Okay. Can I do a recap of what I did? Okay. So all I did is, I want to just refresh you on what Okay, so I said, okay, I have this. Okay, let me rub out some of this nonsense so it just looks a bit better. Okay. I said, I have these tools. I need to do MPT over MPS, add the synergy at the top or add the synergy at the bottom. That's all I want to do at the end of the day. Maximum, minimum. That's what I want to use. The difficulty comes in that synergy can be market value or earnings or percentage. Okay, so, but we'll get to that. Okay. Then I said, okay, cool. I've got these 2 models. I will keep them in mind. If I need to work out the value of a earning, I can put the earning in over here. I need to turn it into a dividend. I'll put the earning in over here. I will divide it by my cost of equity minus my growth. So I need to go search that scenario. That's why I summarized the information. I want to search my scenario. I want to look, did they give me cost of equity? Did they give me growth? If they didn't give me cost of equity, okay, or growth, can I calculate it? Let's talk about cost of equity. If they didn't give me cost of equity, I could have used the capital asset pricing model. Okay. But they didn't. They didn't give me risk-free beta return on market. Okay. What about this? Cost of equity, because remember, they didn't give me cost of equity. Did they give me a dividend? Yes. Did they give me a price? 4.20. Did they give me growth? Yes, they did. They gave me the 5%. Okay. So I know I've got those tools. So all I did is, I said, once I've got those tools, let me go and summarize all of the information. I put in everything from that I would need for those models. If I was given a beta, I would have had risk-free rate. They told me for the merged firm, in other words, I just pay out half of my profit as a dividend. I need that if I want to use my dividend growth model. Okay. Number of shares, yes, they always give me stuff in full value, and I need to turn it into a per share, so I recorded the number of shares. Market price, yes, MPT over MPA, 4.22. I've got half the information I need already for the formula. Okay, they gave me a growth rate. They didn't give me one for micro, I don't need it. They gave me one for the merged firm. So now I know for the Gordon's growth model, I've got growth, I've got market price, I've got dividend. Okay. And then I realized, oh, but I don't have cost of equity. Okay. So I said, okay, I want to do this whole thing. Can I go and find cost of equity? And I realized, yes, I can, because I can take dividend, okay, increase it by 5% to get it to be D1, divide by P0, 4.2, plus growth. And that gave me my 15%. Okay, so from this table, I solved for the 15%. Okay. Then I said, okay, I summarized all my synergies. Okay, I summarized all my synergies. I said, hey, I'm going to get 1.2 million per annum. And I said, oh, that's a problem. That's a problem because I have to turn it into, if I want to put it next to these numbers over here, I have to turn it into a market value. Okay, how can I do that? I can use Gordon's growth model. I can turn the 1.2 into a dividend, 1.2 times 50%, okay, increase it by growth, divide it by 15%, and 15% minus 5%, I'll have a value for that. I can get that, okay? Then I had the 1 million, which I said, oh, no, that's not a real value because it's needed to create that 1.2, so it's just an asset. The 1 million rand in cash is just an asset. Then I said, ooh, the combined group is going to have less risk. And then I said, oh, that creates a problem because it creates all these little synergies. No problem. Let me just value the whole company. I know what macro is worth. I know what micro is worth because I've got those values. Okay, just to remind you, the value of macro, 4.2 times 5. The value of micro, 2 times 2.5. Again, if you don't put the information in this table, you're going to search the scenario 10 times looking for that information. Okay, that's why I summarize it. Okay, so I know what macro is worth, I know what micro is worth. Let me just value the whole company. Okay, valuing the whole company, I want to use the Gordon's growth model. Okay, I'm going to take my earnings. 4,000 plus 800, okay, that's my earnings, plus the synergy gives me a further 1.2 million in earnings. So my total earnings for the whole group, all the companies together and the synergy, okay, was the 600,000. I said, okay, cool. Now I can value the whole group, 600,000, turn it into a dividend times the payout ratio, which was they gave me the 50% for the merged firm, gave me the 3,000. I then say, okay, cool. All I need to do is plug that into my dividend growth model. 3,000, increase it for growth to get to D1. So dividend to D1, divided by my 14% discount rate minus my 5%. Okay, let's go. There we go, 14%, which was given 5%. That had to work out. 15 minus 1 gave me the 14. Okay. That there gave me a total value of 35 million. Okay. So there's my 35 million. That is the value of the entire group, the 35 million. Macro, micro, synergy, all together 35 million. Okay, cool. I can get to synergy now. Deduct the value of macro, deduct the value of micro. Okay, cool. 4.2 times 5 to get macro, 21 million. 2 times 2.5, 5 million. Straight from the table. Okay, that leaves me with a synergy of 9 million. That means that if I go and I say, hey, look at this little thing over here, the value of this, okay, that, and that, all those little synergies is all equal to 9 million. Okay, who's the synergy going to go to? Okay, if the synergy goes to the target company, add the 9 million at the top, make it per share. They had 2.5 million shares, 9 divided by 2.5, and then do that little formula, I get to 1.3 shares. Okay, so in other words, again, if I take that whole group and I say all the little pieces of synergy and the value of the target, if that all goes to the target shareholders and the acquirer only keeps their little bit, their little company, then we do a share exchange ratio of 1.3. The acquirer has to give them 1.333 shares. Okay. Alternatively, if the full synergy goes to the acquirer, add it at the bottom, divided by their number of shares, they have 5 million shares, add it to the 4.2, and we get to 0.333. Okay, so that would be if all the synergies and the acquirer value will go to the acquirer, the target shareholders just keep what they've got. Okay, that's basically what we would do. Okay, it is quite hectic. I won't lie. I think it is. That's why I wanted to do the whole thing with you. Okay. Okay, guys, it is 8 o'clock. So we've got 2 hours left. How are you feeling? We did a hectic, I'll tell you what I think. We did quite a hectic dividends lecture that took long, okay? We did this thing which probably blew your mind a little bit. We can do the next tut, which is well and allied. It's a very similar process. Or do you want me to do it with you separately, maybe as part of the revision? So you can digest this whole thing, play around with this one, and then we do it again, and then you've got a second example that I can show to you then. Okay, because I think you're all blazed now. And, okay. It's not because I'm tired, hey? Okay, cool. Thanks, guys. So that's it. We'll see you tomorrow.